following program is a presentation of the Options Insider Radio Network. For more programs, visit www.theoptionsinsider.com or search for Options Insider Radio in iTunes. It's time for Volatility Views, the premier radio program for volatility traders. Each week, we'll dive into the world of volatility, how to manage it, profitable strategies, and how to avoid the pitfalls of trading volatility. If it involves volatility, you'll find it on Volatility Views. And now, the Volatility Exchange is proud to present your hosts, Mark Longo and Don Schlesinger.
All right, and welcome back, everybody, to Volatility Views, your weekly glimpse into the world of volatility and volatility trading and all the fun stuff that goes along with that, all the interesting products and interesting new developments in the volatility landscape. We're going to chew it all over here on this program. My name is Mark Longo from theoptionsinsider.com, as well as the Options Insider Radio Network. And I am pleased to be joined on the old Volatility Views panel once again by my partner in crime here, the yin to my yang, the dark side to my light side, the degenerate premium seller, if you will, to my occasional once-in-a-while premium buyer. None other than Don Schlesinger from the Volatility Exchange. Don, welcome back to the show, sir.
Another weekend when I'm called a degenerate. I guess it's not the first time and it won't be the last.
You've had some interesting weekends of late, it sounds like.
Well, I can tell you it's not snowing here. That's a big plus. And it's been quite a crazy the last couple of weeks. We've still got snow all over the place. Some of it melted, not all of it did. And we are a balmy 37 degrees as I speak to you now in the first couple of days of spring. So maybe at some point we'll get there, but not yet.
Speaking of balmy weather and the occasional bit of snow, we are also joined this week by our infrequent contributor, but he's on every once in a while, far too infrequently, I'm sure, for a lot of our guests. None other than good old Andrew Giovinazzi, beaming in from the great state of Maine and coming to us via optionpit.com. Andrew, welcome back to the show, sir.
It is always a pleasure to be on Volatility Views, where I can duke it out. I can't say with the dark side. What's Don? Because you're kind of your yin to your yang, your light side to dark side. He would be my juice seller to my juice buyer. Although I do sell plenty of options.
You're a degenerate. You're a degenerate juice buyer if ever I met one. Of course, you like to get stuff for free, so you're a little bit. You're probably in between.
Relative to Don, I'm a ridiculously. Because I actually bought a contract once before. So that would be infinitely more than he has bought. Actually, he did buy one. So
don't tell Don.
I bought one and that's it.
Don't tell Don, but I'm working a buy order right now. Of course, it's on a ratio, so I'll be net short units, Don, so that might make you happy.
There you
go. He was sweating. I could feel his sweat coming through the...
Yes. He used to say, listen, I'm going to leg into a ratio 1/2. Let me sell the 2 first, and then I'll see if I ever get around to buying one.
I like that. That's how you sold it to the risk manager. That's a good approach. I'm going to do the hard leg first. I'm going to do the selling leg first. The buying is easy. I can buy all day. I like that. All right. With that idea in mind, don't take that to your risk manager, folks. That's just a subtle suggestion. We're going to roll right on into our volatility review.
It's time for the Volatility Review.
All right, and welcome to our Volatility Review. This is, of course, the portion of the show where we look back on the week's worth of action from a volatility trading perspective, and it was something of an interesting week from a vol perspective, going back for most of our earlier shows this year, really was kind of a meandering volatility landscape. We had that 1 week where we had the VIX/vol squeeze where it kind of gapped up to 18, 19 handle in that range, and that was pretty much about it for most of the last few months. Over the last couple of weeks, we've actually seen some vol pumping back into this marketplace, a little bit of action, a little bit of volatility. And since, Andrew, I know you love watching the VIX all day, perhaps we'll start with you. What over the past week really caught your eye from the VIX and SPX vol trading landscape?
Mostly, I think, at least from a VIX point of view, was actually how little the latest European crisis affected the volatility. The VIX went up for sure, no question about it, from very low closing levels last week to, I don't know, what did we trade? I think we traded close to 15. I think we got to almost the 15 VIXs. 14, 17, I think was about it for the week. I was just thinking of the futures. They got a little higher than that. I don't know, 1536. We did have an intraday cash on Tuesday. So the futures got up there. And the funny thing, last week we saw crazy future premium over cash all week. And maybe it's because of the Cypress thing was happening or whatever. But we are now at around a 13.5 VIX. The vol has not done much today. It's come off a little bit. Mostly probably they're marking the weekend out slightly as we wait for whatever goodies the EU and Cypress have on Monday, which is still, I think, that's a fair gamma bet, to be honest with you, one way or the other on how they deal with this Cypress thing as far as making the market move.
I think you're the first I've heard refer to them as goodies. I kind of like that.
And I was looking at it yesterday, how they priced the SPY gamma, and actually I was thinking about, I know Don is going to be, but a 1 week strangle in the SPY, and it would have been at least almost just in the money today because we've had a pretty good move. So, I think when the volatility is pricing at around 12% near term, you don't have to spend too much money. And the market is still giving us a couple of moves here and there. So with good news all week, we really haven't gone anywhere. And I will be very interested to see what happens. Maybe we snap up kind of hard next week, or we go into the deep, dark recesses of, maybe some near-term lows next week if Cyprus can't deal, if the EU can't really deal with this problem. It seems like a relatively small problem, but at least from the volatility market point of view, it has not really become anywhere near the problem, let's say, that Italian election was, let's say, 3 weeks ago.
Yeah, we saw a nice little Cyprus-related bump at the beginning of the week in the VIX, and then we seem to have kind of meandered ever since then, kind of come off a little bit. Everyone's thinking we probably overreacted a little bit earlier in the week to the news of Cyprus. It is a big deal, but at the end of the day, it still is just Cyprus. I don't think it really is everyone's thinking of it as the tinderbox for the rest of Europe. I don't think we're there yet. So I think the market is reflecting that now. A little bit of a rally today as we're recording this. Most of the major indices up about 0.5% on the day, and VIX coming off accordingly. The VIX cash down about nearly half a handle as well. And that's kind of been the story for most of the week, where we had the VIX kind of gapping up and then kind of meandering down as people take a deep breath and realize, well, it's important, but it is just Cyprus at the end of the day. So it's certainly no Berlusconi.
Certainly no Berlusconi, and wondering if they actually make some creditors, some type of creditors start to eat something here. So I find it, again, interesting, and that the Europeans are still kind of messing around with something that they never really dealt with firmly, but how do you deal with, it's like our government, how do you deal with it firmly?
Yeah, how do you get your handle around it?
They're still carrying $700 or $800 billion a year in deficits. And they're moaning and groaning when they can't spend $50 billion. So maybe the EU's not doing such a bad job after all, considering they got, 18 different governments trying to figure it out? It's amazing they get anything done.
Now, Don, I know you had a lot of your cash parked in Cyprus, so hopefully this doesn't impact you too directly. But aside from worrying about your own personal holdings, what has caught your eye out in NASDAQ vol land for the past week?
You wake up every morning and you say this little speck of an island, in the middle of sea, and how the whole world is hanging on it. That's the interconnectedness of markets these days. But be that as it may, we have an interesting situation that you don't see all that often. Short-term NASDAQ volatility, 21-day realized historical actual volatility, is actually a couple of hundredths below the S&P. So both of them are in the high 10 handles. We've come down just a drop, maybe 0.4 of a percent from last week's show. So certainly not a whole lot going on in the actual or real volatility of the major indices. NASDAQ sits at 10.8, S&P at 10.95. But what did happen, and what we did discuss in last week's show, was that widening of the spread between implied and realized volatility. So again, we've discussed it many times, a traditional risk premium of implied over realized of about 4 or 5 points. And we pointed out that the two were actually the same last week, both at about 11 and change. Since then, VIX has gone up to the high point that Andrew mentioned in the 14s, only to back off a little bit today, while realized actually retreated about half a handle or so. So we have a much more traditional spread now of about 13.5 VIX, about 10.9 on the S&P. It's not quite the 4 or 5 points that I mentioned, but it is some sort of a normal situation with implieds above realized. So watching those spreads, it's interesting to see that when they really get stretched, and whereas it's fairly unusual to see VIX as the same as the realized, doesn't last very long before things kind of snap back into place. Final comment that I would make is S&P's up about 64 hundredths of a percent as we speak. VIX is down about 3.36% on the day. So that's about a 5-to-1 ratio. And it's kind of normal when the market goes up for that to be that kind of a ratio. Some of it's due to the weekend. Some of it's due to the inverse relationship between an up movement in the index and a down movement in VIX. So things are pretty much according to the way they should be at the moment. Final comment that I would make, this is just a price comment and not a volatility one, mentioned last week about it's generally hard, and as an observer of the market, I've noticed that when you have all-time highs, which of course you don't get to all that often, you rarely tiptoe through them, and I mentioned that last week. We flirted with that 1565 level on the S&P, can't quite break through it. Today we're up about 10 handles or so to 1555. Doubt very much whether we'll blow through that by the end of the day. So once again, when the time comes, if it comes, for establishing a new high, chances are you're going to see some really kind of blowout action, some piece of news or something that's going to send us much higher. And on the day that we close at a high, I'd predict that we'll be in the 1570s or higher, and not just, settle 1 or 2 points above that historical 1565 that everybody's looking at.
Yes, everyone is indeed focused on those historical levels these days. Seems like that's all anyone could do is focus on Cypress and on the new highs and on these historical levels we're hitting in the marketplace, and rightfully so. There is a lot of interest on those levels. Unfortunately, listeners, I know you guys love it when we have guests, and we've had guests lined up for the past couple of weeks, and it seems like one different internet calamity or another has prevented them from joining us on the show today. That is indeed the case again today. Our guest is having a number of internet problems, so we'll have to reschedule them for a later time. But there is a silver lining to this, because that gives us some time to get to some of your listener mail. We haven't had a chance to crack open the mailbag in a little bit, and we're not going to have a chance next week because of the holiday. So this is our chance now to answer your pressing questions. So here we go with the mailbag.
Listener mail. Listeners write in.
Mailbox.
All right, and welcome to the old listener mail segment. And just a quick reminder, if you too would like to be featured on an upcoming listener mail segment, there are a number of ways to do it. You can surf on over to theoptionsinsider.com and post a comment on our site like our listener did today. You can also use that system to shoot us an email, or you can shoot us an email directly, questions@theoptionsinsider.com. Just make sure you put the name of the show you're asking about or commenting on in the subject line so we know where to route your question. Of course, you can always find us on Twitter, twitter.com/options, or on Facebook. A lot of different ways to get in touch with us and get your comments/questions featured on the show today. All right, and first up, we have a question, and Don, I can hear you smacking your lips in the background. And I wanted to feature this one first because it is on the surface of it and on the face of it a very basic question. And we've touched on different aspects of this on the show over the 2 years, but it seems hard to believe. But I don't think we've ever actually sat down and addressed this specific question in its entirety on the show. So I think this is a good chance to do so now. This question comes to us via theoptionsinsider.com from Jim Petchi. I hope I'm pronouncing that correctly. And he writes, I've been listening to Volatility Views for a while, but I still don't understand how the volatility of a specific option relates to the probability of the change in stock price. Does the implied vol of a specific option, and he writes in parentheses, like Apple today at 443 with an April vol of 29%, mean that Apple has a 29% chance of making a one standard deviation move, which is 67%, in that time frame? If not, is there some way of relating the implied vol with probability? Now, there's a lot of ways to start with this question, but Don, like I said, I can hear you really smacking your lips. You want to get into this one first, so I shall give you pride of place, sir. What would you like to say to our friend, Mr. Jim Petchi?
Well, first of all, he's honest in saying he doesn't still understand how this works, and the question actually demonstrates that, which is fine because there are some complicating issues here, and we'll try to get to them. So there are a number of aspects to this. There's the concept of the difference between implied and realized volatility. There's the concept of which to use when you're contemplating a movement in the underlying. Then there's the concept of what a standard deviation move actually involves for a stock price, and the difference between the options implied and realized. So I'm going to kind of start from the beginning and try to synthesize the whole thing. Might be a little bit difficult to follow if you're driving in a car and listening to this. If you're home somewhere and can snatch a piece of paper and pencil and maybe write some of these formulas down or take some notes, that may be beneficial. But I'd start by saying that the question asks how the options implied relates to the probability of a change in the stock price. And I would point out that if you're going to consider the underlying, if you're going to consider the stock itself, and you want to make some sort of a probabilistic statement about the stock price movement, then you ought to be considering the actual realized or historical volatility of the stock itself and not the options implied. So the first problem is that when you look at options, you have a whole range of implied volatilities. We've spoken about the skew over and over again, and our writer may be familiar with the fact that you've got calls, you've got puts, you've got in the money, out of the money, at the money. All of these options have different implied volatilities. So even if you were going to use an option volatility, which I'm not suggesting, you have a whole gamut of them. So let's just concentrate for the moment on the April options that were mentioned, and let's talk about an at-the-money option. And the writer says 29% implied volatility. Well, again, we've spoken over and over again about the fact that that usually represents some kind of a risk premium above realized, and we just talked about that spread a few moments ago in our introductory segment. So I don't have Apple in front of me in terms of 21-day historical volatility, but let's just make an assumption that the spread could be 4 points, 5 points or so. And if you're looking at an at-the-money volatility implied for April of 29%, maybe the current 21-day historical volatility for Apple stock is somewhere in the neighborhood of 25%. Let's make that assumption. If we use that 25% to try to make some statement about the price movement of the underlying stock, first thing that you have to do is you have to annualize that number for the period that you're studying. So our writer makes an error when he talks about 29% movement, because obviously you're talking about an annualized figure, and April is just 1 month away. So step number one is to take that realized volatility of 25% that we're going to use for Apple price movement and say how much that would convert to for a 1 month period. So you would say that 1 month is 1/12 of a year, and expressed as a percentage, 1/12 is 0.8333, etc., a little over 8%. But listeners might understand that volatility is a square root function. So when you talk about how you change a yearly volatility to a monthly volatility, you don't just divide by 12. Instead, you use the square root of 12. And so if you take the square root of that 833 that I just mentioned, you get 28.9, almost 29%. Coincidentally, it's the same number as that implied volatility, but that's just a coincidence. So now we've annualized this period for 1 month, and we're at 29%. And we also said that the realized volatility was 25% for the whole year. So if it's 25% for the whole year, we take the 29 figure that we just got by using our square root, and we find that that converts to a little bit over 7% for the month, 7.2%. So we're kind of in the home stretch now, because that's the number that you want to look at. You want to take Apple's price, 443, and you want to say very roughly that a 1 standard deviation move up or down would be approximately 7.2% of the underlying price. Now, there's another fine point here, which isn't really worth bothering about with small volatilities, but can be more appreciable for large ones, and that is, most people make the mistake of looking at the stock price and then just saying, I'll go up 7% or down 7%. That would be true if you were looking at a standard normal bell curve. You have a symmetrical distribution. However, stocks that are normally distributed show a slightly different distribution. So actually, to be more precise, this is an exponential function, and what you need to do for those who are a little bit more mathematically inclined is take the exponential, the logarithmic e, and raise it to the 7% power. You get a little bit more than 7% to the upside and a little bit less to the downside. Again, not by much when you're with small numbers, but when you start to get something like a 30 or a 40 volatility, you're making a mistake if you just go up 40% or down 40%. It no longer works that way. You need to do e to the 0.40 and e to the negative 0.40 to the downside, and that's when you find that the numbers might be as high as 45 or 48% and only like about 32% to the downside. So it's not symmetrical. So the final step is to then just say, I'm going to use that number, and I'm going to create a 1 standard deviation range or a 1 standard deviation bandwidth around Apple's price of 443, and I can make my final statement as to the movement of the stock price for the next month. And the way you make that statement is to say, let's take about 7.5% of 443, and that would give us something in the range of about 33 points or so. And about 7% to the downside, maybe 31 points or so. So the statement to make is, for the next month to April expiration, there is a 68.3% probability, that's 1 standard deviation width around the mean, that Apple price will be somewhere between down 31 and up 33. So you create this kind of bandwidth. You subtract 31 from 443, you get 412. You add 33 to 443, you get 476. 412 to 476 becomes your 1 standard deviation band, and you say that there's a 68.3 or just about a little bit more than 2/3 probability that Apple will be trading somewhere in that range over the course of the next month. Finally, if you want to go out 2 standard deviations, you use that same 33 and 31, you multiply them by 2, 66 and 62, you add it, you subtract it, and you make a statement that 95.4% of the time you'll stay within 2 standard deviations up or down. So that's how you use this information, and basically you need to take a look at the actual volatility of the underlying stock itself, annualize, convert from a yearly number to monthly or quarterly. If you're doing it with a precise number of days, use 252 days as your denominator for a yearly number, and the number of days that you're considering for the numerator. Form the fraction, take the square root, and then multiply the volatility that you're using by that annualized number that you get, and then add and subtract from the stock price.
All right, Don, I knew you would be ready up for the challenge of that one, and certainly you rose to the occasion. So there you go, dear listener. Hopefully you weren't driving when you listened to that one, because that was a lengthy answer. If not, if you're still confused, just pause it, go back, rewind it, listen to that again. I think Don hit on all the salient points. There's nothing for Andrew or I to add there. That's really the full definition.
It was far too good. It was far too good.
Andrew and I were ready to go, then we realized, no, we're not needed on this one. So that saves us. But, we do have another question, actually. And, Andrew, I was going to actually pose this to you on another show you do with us, because that was, I thought, were the next time I would talk to you, but I didn't know you'd be coming on today. But this actually is a great opportunity, because there's a listener wrote in an email directly for you. And this is in regard to an article you wrote for us a week or two back on the Options Insider. If you want to follow along yourself, listeners, you can search for this article yourself. It was entitled Risk Reversals Trade in BPI. It was an unusual activity alert where Andrew ran down some unusual options activity we were seeing and what that implied for the underlying, what that meant from a volatility perspective and from a different positional perspective. I can give you a quick overview of the article in question now. It was talking about Bridgepoint Education Inc., ticker symbol BPI, and Andrew wrote that today the BPI 10-12.5 risk reversal traded where the paper sold the May 10 puts for $1 and bought the May 12.5 calls for 40 cents for a total of 2,500 contracts. The average contract volume is about 700 contracts. In this name, open interest is over the volume of the trade on both strikes, and the implied volatility is overall down in May. This trade looks like it's closing and reopening in the August 10-12 halves, where the customer bought put and sold calls to create a collar 2,500 times. Of course, the trade went up as a buy right, and both could be linked. 30-day implied vol is 69%, 10-day implied vol is 26%, and the 30-day implied is trading above the 10-day historical volatility. Now, we had a listener read that article and then right into Andrew. He is Mr. A. Heiner, and he writes, "What does this mean? I apologize, but I do." That's a pretty broad question, right? But he writes, "I do not understand the market and what this says about the future of BPI and its price. Can you break it down for me?" Of course, there's a lot of different, perhaps advanced terminology being thrown around in the article, so I think we could bandy about a couple of them. Maybe we'll start off, Andrew, with what you meant by, of course, the closing and opening, and then let's get into the buy right, because I think that probably is what's throwing him off a little bit as well, what you mean by that and what that actually implies for the outlook of the underlying versus what someone might think when they initially look at that position.
All I can say is I. There's been a whole lot of option talk thrown around here. That's sorry. There's just a lot of option talk just now.
Yeah, I was trying to squeeze it all in a few seconds for our listeners here.
I was blown away. So this is essentially as I see this trade. So in general, trades go up on an exchange, and if they are linked with stock or they had a previous stock link, they could go up flagged as buy right. Buy right just meaning the customer has some underlying equity position and they want to trade some options against them. That's kind of like generic buy right. Mostly just selling some calls against some stock.
Yeah, it's a pretty straightforward term. You're usually buying stock and writing calls, hence the buy right terminology.
Hence the buy right. So in this case, though, the customer actually wanted to create the trade, but buy puts as well. So what they're trying to do is what a collar trade is you buy puts and you sell calls against a long stock position. And generally, long story short, it turns your long stock into a long call spread. That's basically the same risk characteristic because you have a long put and long stock. that makes a long call against the short call you sold, and you end up with basically a synthetic call spread. The difference being is you get to keep the long side and you roll the option pieces. Roll meaning, the trade will collapse at some point at expiration, and you roll it usually about 3 months out to 6 months out. Now that you have the weeklies, you have all kinds of fun to forward sell calls. But in this case, what the customer's doing, they're closing their May, and they rolled out to August. Now, the reason they want to do it is they want to keep their stock. They want to keep their stock, and they want to buy the 10 puts against it. So they're, and because of these education stocks, they've had a little bit, we'll just call it a little gamey existence here because of, how the government treats the revenue or how the education stocks are treating revenue. They're basically kind of poking around 52-week lows. So what this customer wanted to do is they just wanted to create the risk from there. They want to basically belong from 10 to 12.5. But they don't want any risk below that, but it's pretty clear they actually want to own the shares outright eventually. So what the roll does is they had the position on initially. They closed, they bought back their 12.5 call and sold out their 10 put. And they're actually moving it out to August, where the idea is they hold their stock, or basically their long synthetic call spread out till August. So I would say it's bullish in the fact that they still own the stock and they don't want to get rid of it, but they're doing it kind of in a risk-controlled way. So to make Don happy, you're buying options, yet you're selling them at the same time. So I think a call spread probably still qualifies for Don as a long option trade, even though net you're not really short any contracts.
Yeah, but you have the unfortunate situation of having to pay for it, right, Andrew?
You do. Well, one thing I like to do is if you trade collars, I don't like spending money for them. Now, as I didn't see the collar price when this went up because we had when they rolled the thing, so I don't see the August price. Normally, I don't like paying for collars, which I have kind of rules about these things. And I don't like spending money on them.
You're Mr. Free Juice when possible.
Right, free juice when possible. I would prefer to take the risk in the window of the difference between the strikes and not necessarily on the option dollars and cents themselves. So, I would say this is a customer that still wants to be long. They're a little nervous, and they're more than happy to take their money from around the 10 to the 12.5 strike, which is still a pretty good return, probably around 20%, and off they go. And that's how I would read that particular trade. So
there you go, Mr. A. Heiner. Just a quick rundown then of what we were talking about. You're right, it is indeed a little bit of options jargon thrown in there. Perhaps sometimes we get ahead of ourselves when we write these things up. We assume everyone is following along at the same level, but it's good every now and then to stop and look back and talk about what we're really talking about there in a lot of terms, buy rights, rolls, and things that could confuse a lot of people. So again, if you want to read exactly what we're talking about, just search for BPI. Go to the Options Insider, type BPI into the search box, and you'll find this article by Andrew.
All kinds of stuff. All kinds of stuff. Yeah.
All kinds of stuff.
All kinds of stuff about people, what they're buying, what they're selling. I like the one today, actually. I know nobody will be able to read this or hear this until Monday. But EGO, I think it's a huge amount of volume going up. And it just feels like a gigantic bet on the bottom of the gold miners. So somebody's buying literally tens of thousands of calls in a little $9 stock, which I find quite interesting.
Yes, if you like this kind of thing, listeners, if you like unusual activity alerts and updates, we do quite a bit of it on the Options Insider, so you can surf over and check it out. In fact, we're doing a whole event based around this exact thing. We're going to have our Unusual Activity Summit on May 15th here in Chicago. If you're going to be in Chicago, you need to attend this event. We're going to have just a retinue of fantastic speakers and a lot of great bonus prizes for people who sign up for us at the gate. You can check it out, theoptionsinsider.com/events to learn more. Like I said, great lineup. Even squeezing in for you guys a very rare tour of the CBOE trading trading floor so you can see where all your favorite products trade in their natural habitats. And you can do it before the trading floor goes away. So if you haven't had a chance to see that environment, this is a great chance to do it. So see all of that and more at the Options Insiders Unusual Activity Forum, May 15th in Chicago. TheOptionsInsider.com/events to learn more. I know Mark will be there. Who knows? Maybe Andrew will even show up from Maine. You might have a great turnout there at the Options Insider event. So check that out if you're interested. And with that, we're going to close out the old mailbag for this week. Thanks to all of you who participated. And we're going to keep on rolling into our final segment, the Crystal Ball segment.
And now we take a look at the crystal ball.
All right, and that haunting music means that it is time for our final segment. Of course, I'm talking about the crystal ball. This is the portion of the show where, as the title implies, we peer into the future a little bit and tell you what we're thinking, what we're watching for the coming week from a volatility perspective. And actually, because we're going to be off next week, because it is a holiday, this will actually be a 2-weeker. We'll be doubling up on our prognostication here in the crystal ball segment. So, Don, why don't I give you pride of place, because you haven't had a chance to talk in a bit. Your voice may be running dry. So we'll give you a chance to dive in here. I know you had a nice rest after that long explanation in the mailbag. So tell our listeners what you're looking forward to, what you're thinking about for the coming 2 weeks now. Remember, it's the double week period for NASDAQ vol and any other vol that may be catching your fancy.
Well, tough enough to look forward 1 week when you're trying to predict something like volatility or market movement, and I continually insist that it's unlikely that you're going to get one direction right without the other. So if you try to make any kind of a prediction about where volatility is going, you better have a pretty good idea of where you think the market is going. I'm going to go out on a little bit of a limb and say that this latest crisis or mini crisis concerning Cypress is going to be resolved, and it's going to be resolved in a manner that's satisfactory for the marketplace and clear the way for the potential for new highs for the S&P. Of course, we never speak about new highs for NASDAQ. We're not in that territory, and we've already crossed new highs for the Dow. So the one that's kind of close within reach is S&P. So I'm going to say that the next time we chat with our listeners, we're going to have blown through those highs, which will probably take at least implied volatility lower than it is today. And we'd have to reserve judgment on realized. We're in the 10 handle right now. That's fairly low. It could go even lower still if the advance is an orderly one. But if we were to blow through and have a couple of really big days to the upside, that actually adds to realized volatility, since we're basically just measuring the magnitude of the movement and not the direction. So I'll say, in terms of market direction, higher. In terms of implied volatility, lower. And in terms of realized volatility, I'm going to kind of take a pass on that one because it could go either way.
Ducking down, sir. That is unlike you, but I understand. It is a long period. A difficult thing to dive into the mix.
Well, I gave you 2 out of 3.
There you go. There you go. 2 out of 3. It ain't bad, as they say. Mr. Andrew, what is catching your eye? What are you watching? What do you think we'll be seeing over the next 2 weeks now? Double week period here in the land of VIX and S&P 500 volatility.
You know, it's funny. The last time Don and I agreed is right before the Friday before that Italian election, when we both thought the realized vol was going lower, or implied volatility was going lower, I think. And then we had the boom. So actually, we were right except for one day. That was a great one-day selling spree. But where I think we have, you get past Cypress, and I think the gun is fairly loaded for. A move higher. Somehow the market seems to, they like the fact that the government's not spending money and all the numbers are better. To me, the only thing is when does the government stop buying bonds? Apparently, they're not going to do it this month. So I don't know how much good news. I guess he's going to say, hey, not until we're at 6.5%, I'm going to stop buying bonds. I guess that's when every currency is going to be worth zero by then. But for the next 2 weeks, us getting by the Cypress thing, I think we will see a new high. We'll not definitely, but I think we'll see a new high. And I think actually it will have a relatively brisk up move. And I'm going to say, I actually think the realized vol can go higher in the meantime. Reason being, we're at such a low level right now. It's hard for me to think of anywhere it can go but up, because it's just really, really, we have 10-day realized vol is 8%. I mean, that's just low in the S&P 500. So I'm going to say realized up a little bit, implied volatility down a little bit. And this is all, of course, on the back of Cypress being resolved. But I wouldn't be betting that the implied volatility, I wouldn't be making that sale today. I'd be making that sale on Monday or Tuesday.
Yeah, you don't want to put it on right now. Of course, we're recording this midday on Friday. That's always the sucker's bet, giving away that volatility when the weekend has already been taken out, particularly when we have a lot of stuff looming over our head like Cypress. Anything could happen over the weekend. You don't want to give away a weekend's worth of risk for nothing. Wait for that little pop to come back in on Monday morning, and then do that. Don, I'm sure you were always cagey of selling your options on Friday afternoon every week, correct?
Well, it was one of these one-upsmanship things. Everybody knew that they're going to start sucking the premium out of the options even early in the day on Friday. So you wanted to be ahead of that. So you started looking at Thursday. The question was, how early could you start? And it's kind of like before Thanksgiving, when we knew that you're almost going to get 4 days worth of premium because Thursday you close, Friday half the people don't come in, then you've got Saturday and Sunday. So, you thought to yourself, well, I'll get started on Wednesday afternoon, only to find that everybody else had started Wednesday morning. So it's kind of hard to know just how far you back up. But I'd certainly agree that Friday afternoon at 2 o'clock is not the time to start.
No, not the time you want to start hitting bids when the bids are already substantially lower.
Well, plus you have the problem of it's Thursday, middle of the day Thursday, and you're like, uh-oh, maybe I started too early.
That's the point. So it's kind of like that delicate balance between not trying to get out the door when everybody else is rushing ahead of you and starting a little bit too soon where you might have wanted to wait, just have another look or two.
Right.
Exactly. Keep the powder dry. It's always better to, perhaps as Don would say, sell or perhaps don't sell in these types of equations. And it's certainly no shame in not selling. I think that's the message we need to drill into all of our listeners.
Yeah.
If you're not certain, don't put anything on. It's a good policy to have. Well, unfortunately, that's all the time we have for this week. We're going to close up a little bit shorter this week, listeners, because as we said, our guest could not join us this week, but hopefully we'll get him back on in a coming show. We're taking the next week off because of the holiday, so if you're looking for a Vol Views next week, there will not be one, unfortunately, but we'll be back here in 2 weeks. Before we go, I want to check in with my cohorts here, my partners in crime, to see what they have coming up in their necks of the woods that may interest you, the listener, something you guys can do over the next 2 weeks while Vol Views is on a little bit of a break. Don, starting with you, what is coming up in the land of the Volatility Exchange, aka volex.us?
Well, one of the things I'd like to mention is that we have an ongoing interest in keeping readers current with literature, with articles that come out, as you do such a great job every day in your daily posts. We try to scour for academic articles, anything that may have appeared of interest to our readers, and we put them all in what we call the Volatility Library. And we've just added yet another piece about a week ago or so. So, if you take a look and you look at recent posts, we have titles such as Volatility as an Asset Class, Are VIX Futures and ETPs Effective Hedges, Capturing the Volatility Premium Through Call Overwriting, market risk for volatility and variance swaps. There's an awful lot of really interesting and good stuff here. You don't have to be a mathematician to read all of these articles. Sometimes, as I've said in the past, if you do nothing more than read the abstract at the beginning and the conclusion at the end to get the gist of the major points that are being made, you can learn a great deal just through that and looking at some of the charts and graphs and what have you. So we're constantly on the lookout for keeping this fresh and up to date, and I would invite listeners to come on over to volex.us and have a look. Let me add in closing, please, that I'm actually going to be away for several weeks. There may be the possibility that I can do the show from where we'll be, and as a result, kind of use my Skype no matter where to participate either in the first or second week in April shows. But in the event that that not be the case, we'll have Bob Kraus, who is the CEO of the Volatility Exchange and has quite ably filled in for me on several occasions in the past. So if I am not there for those one or two shows going forward, let me take this opportunity to wish all of our listeners a very happy Easter, joyous Passover, happy holiday season, and I hope to be speaking with everybody shortly.
Thank you for that, Don and Andrew. In addition to our, of course, upcoming Unusual Activity Forum on May 15th, what else is cooking over there in the land of optionpit.com that may interest the listeners of Volatility Views?
We have the April 20th on Saturday with Mark Sebastian, Russell Rhodes, and some people at thestreet.com. Talking about various methods to trade the VIX. That is April 20th on a Saturday. And for most people, they look at the VIX, and given, that our classes are full every month and the way our students come in, most people do not understand how the VIX works or how it trades. So this is one of those things where you go to a class and you actually learn something, learn how it works, how we use it. And we use it in all kinds of tricky ways, which actually we were thinking about talking about today, and how we use the VIX to hedge. So we can pretend to be like me and pretend to be like Don at the same time, which you can do if you're a little clever, but we will wait for that on another subject. But again, getting an introduction to how the options and futures work on the VIX, it will definitely help you out in the future. And if you are an Option Pit anything subscriber or whatnot, you can get a, work a deal with Mark and get a pretty good discount on that. So anyway, let us know at optionpit.com, and we'd be happy to sign you up.
There you go, listeners. All sorts of great deals and great things to check out over the next 2 weeks while Vol Views is off. You can surf on over to volex.us and, of course, pick through that volatility library. A lot of great stuff there, including some of the papers Don mentioned, some of them being from guests we've had on this show. So you can see the actual research, the actual literature we were discussing on this program. Of course, you can surf on over to optionpit.com and see what Mark and Andrew have cooking over there, maybe some classes that may catch your eye. And of course, when you're done with all that, you can surf on over to theoptionsinsider.com. You can find all of the archived episodes of this program, as well as every other program we have on the Options Insider Radio Network, including an interesting new show we just launched a few weeks ago called the Options News Rundown, a daily 5-minute or so rundown of the top headlines from the world of options. If you like options and options trading, I think you're going to like that show, and it's a very quick commitment, only about 5 to 10 minutes, so you'll like that one as well. And of course, I want to hit it again if you're going to be in Chicago on May 15th, and we'd love to see you down at the Chicago Board Options Exchange for our Unusual Activity Forum. A lot of great guests, a lot of great speakers, and a lot of great items available for our attendees. Surf on over to theoptionsinsider.com/events to learn more and how you can get the early bird pricing for that event before all those seats are gone, and they're filling up pretty quick. So on behalf of Don and Andrew, I want to thank all of you out there in the listening audience for downloading and streaming and subscribing to this program and making it such a success. And we'll see you next time right here on Volatility Views.
Thank you for listening to Volatility Views. Join us next week as we keep our listeners on the cutting edge of finance and risk management with lively topics relating to volatility. Volatility Views is brought to you by the Volatility Exchange. If you'd like to learn more about vol contracts, please visit www.volx.us. If you'd like to submit a question for the hosts, then surf over to www.theoptionsinsider.com/forum and post your question in the Volatility Views forum. Questions can also be submitted via email at questions@theoptionsinsider.com or via Twitter at twitter.com/options and twitter.com/volx_info. Facebook users can submit their feedback via the Options Insider and Volatility Exchange Facebook pages. Voicemails are also welcome at 312-544-9356. Thanks again for listening, and we'll see you next time on Volatility Views. The views expressed on this program are not intended as investment advice and do not constitute an offer to sell or a solicitation of an offer to buy any securities or other financial instruments and may not be relied upon in connection with the purchase or sale of any security or other financial instrument. The opinions presented on this program represent those of the speakers and do not reflect the views of either the Options Insider Incorporated or the Volex Group Corporation. The preceding program was a presentation of the Options Insider Radio Network. For more programs, visit www.theoptionsinsider.com/radio or search for Options Insider Radio in iTunes.